Hi traders, you're welcome once again to my channel. I am OTJOSH, and in this video I want to be talking about fake breakout and how to trade fake breakout, how to spot fake breakout, and how to take advantage of fake breakout. So first of all, the introduction of fake breakout is that fake breakout is something that is unexpected in the market. It's not something that you can see ordinarily like any other kind of concept or pattern. It comes in a way that you don't expect, and you may think you're doing the right thing, but at the end of the day you find out that you've been hit by the fake breakout and you've lost money in the market. Not just money, you've lost your confidence and all of that. So let me start by saying that the market will always move in one of three directions, which is the upward direction, the downward direction, and the sideways. Of course, sideways, we know this sideways is the ranging market. So over time we can identify one of these movements, and then we get an idea of the overall sentiment of the market. So the problem here is that we often get stuck after we identify this sentiment, because at the time we identify this sentiment, the market may be shifting to a new sentiment. So maybe you are identifying an uptrend. Now you are sure that, okay, this is an uptrend, I want to take advantage of this uptrend. By the time you are getting ready to take advantage of this uptrend, you find out that at that same time the market may be shifting to a downtrend, maybe a minor downtrend, but it may be shifting. And these are the problems we tend to face every day in the market. So what we have to do now is that we are not only going to identify the market sentiment, but we have to identify it fast enough as it occurs. That means when we are seeing an uptrend, we should take advantage of that uptrend immediately. If we let an uptrend run its course and we are trying to take advantage of that uptrend, maybe after some time, we'll find out that we are getting in that uptrend when we are supposed to be taking profits from it. So, and this has a tremendous implication on our ability to anticipate possible market moves. And one of these market moves that we can anticipate is fake breakout. This is why I want to talk about fake breakouts. So what is fake breakout? Fake breakout is a move against the dominant trend or sentiment in the market that extend beyond the points traders had anticipated for in advance. Yeah, when you anticipate a move in the market, it happens just like this picture you can see. It happens that the move you anticipate happens, but it will extend more than what you have anticipated for. So for example, we have an uptrend. Of course, an uptrend is a series of higher highs and higher lows. That's what we can see here. Now when this trend has been coming up, it got to a point where it's retraced or pulled back, and now it has come down to a support level. This is what I marked with this green line. Now it went back up, broke this previous level, and what we are expecting is for it to come back down here and then go up. Now this is how fake breakers starts. Instead of the price to come back down here, what we see is that it came back down and then it kept on going downwards. This is how fake breakout starts. Now you have in your mind that this level is the level that I will be buying from when the price comes back, but to your surprise, the price had come back to that level, but no, it kept on going down. So at this point you will be confused. Anybody can be confused, because you will be looking, you might even see a good signal to buy and you buy, but the price will keep going down. And by the time you say, okay, maybe the market has reversed, let me join this new downtrend because the price kept on going down, The moment you buy, you find, sorry, the moment you sell, you find out that the market will start going up. And this is very annoying and it's frustrating because you can lose your account balance. You can lose, most especially, your confidence in taking setups that you know. It also happens in forex during stop hunts, whereby you place your stop loss at a point whereby you know the price will not come, and then when the market gets to that place, it goes down, hits your stop loss, and then continue going in the anticipated direction. It happens, and it's really frustrating. It happens in an uptrend, it happens in a downtrend as well. The price is coming down, it's coming down. Now you're thinking, if the price comes back to this level of support, this green line here, if the price comes back here, you're going to sell. When price comes back, it does not show you any reversal sign, or it shows you a reversal sign, but you entered the price, you entered at this price, but the market kept on going up. And since the market kept on going up, you think, okay, I'm going to reverse my position and I will join the uptrend. The moment you join the uptrend, the market will start coming down. This is what fake breakout is. In a ranging market, it happens the same way. The market has been moving in a range. It has been moving inside this range. But then we saw this breakout, and we say, oh, this is a good breakout. This is a good breakout. And according to what we have been hearing in trading, when you see a breakout, what happened? You go along with the trend. So you went and you bought here. Instead of the market to go up after you bought, the market kept on going down, and this is really frustrating. It is really frustrating. So what are we going to do? Since we know about these things, what are we going to do? This is what I was trying to tell you about the fake breakout. The market comes down, and then after it broke the level you were supposed to buy from, you see it is now that the candlestick will come up. So at this point, when the market is doing a pullback, there are mental skills that every trader needs to develop. These mental skills, they are what will keep you grounded in your strategy or in your plan, and that key is none but patience. You need to be patient. When the market is coming down, you need to understand that these levels of support and resistance are not just levels, they are zones. And in most cases, you might not see the complete zone. You might just see just a part of the zone. But other traders, the market is seeing the complete zone. So the market would want to take advantage of every low price it can get to. So this is why we get these fake breakouts. When the market comes down to your level, there may still be an opportunity to buy at a lower price. So the market will go down. When it gets to the lowest price, you see now your confirmation in form of this hammer candlestick appear, and you can use this level here and you do your buying. Same thing with the downtrend. When the market has gone up, or you're thinking you want to buy and join, you see the red bearish candle, and now the market is going to go back down. Same thing here. When the market has gone up, you say, oh, this is a breakout, and then you buy. The market goes up, comes down, and then reverses, then the market keeps on going down. So this is how the fake breakout happens. So next, we are going to look at the psychology of a fake breakout. So in an uptrend, downtrend, on range or ranging markets, fake breakout is equivalent to a pullback in an exaggerated form. It's equivalent to a pullback in an exaggerated form. So it's the same thing as a pullback, but this is the kind of pullback that you cannot be sure of, you cannot be too sure of, because there may be so many exaggerations of this pullback, we normally call them noise. There may be so many noise, volatility, and all of that with the fake breakout, and so you can't really tell how it is. So now in an uptrend, let me show you what is really happening in an uptrend when this fake breakout happens. So if we are going in an uptrend and we're seeing buyers entering the market, now I want you to know that for buyers to enter the market here at this point, there must be a kind of motivation. That means, there must be volume, maybe aggression, there may be news, anything that can make buyers want to buy, a positive news. There must be that thing there. The reasons market go up is different from the reason market falls. So for market to go up, that aggression must be there. Maybe at the start of a trading session, a increase in volume, something like that has to take place. So when it takes place, you see the market starts moving up. Now buyers and sellers are trading, but buyers are moving the market. Of course, in every trade, it's always buyers and sellers. It's the one with the upper hand will move the market. So buyers are moving the market. Now buyers get to a point where they feel that I have made enough money, we have made enough money, let's take our profits, right? Now the buyer starts taking profit because they have gotten to that point. Maybe they've made enough money for the day. So when they take profit, what happens? That process of buyers taking profit will automatically send price down, because it means that buyers are leaving the market. Remember, I told you that for this price to come up, there must be motivation, there must be momentum, there must be something. That means if they are taking profit here, it means they no longer see motivation to keep on holding their position, or they are satisfied with what they have. And even if they are satisfied with what they have, it's still the same thing as there is no more motivation. So if there is no more motivation, there is no more aggression, what happens naturally is that the price will fall down. Now as the price has fallen down, this is where me and you become important. We are not the one who is going to take this price up, because we don't have the financial capability, not even the psychological capability to take the price up. What we do have is the intellect to notice what has happened before. So when we see that price has gone up before and now it's coming back, we always like this move. We know that if we had entered into this trade here, we would have made money. So what we do is that we wait at this same point, we wait. When the price is coming down, those traders here who feel that they've missed this move, they are going to enter again as a new set of buyers with the same motivation, maybe the same news, volume, the start of the London or New York session. They will enter again in the market. So when they enter again in the market, the price is going to go up. Right? Now, when this price has gone up, we may think, okay, we've had enough profits, so let's leave the market, or there is no more volume in the market, there is no reason, there is no fundamental reason for price to keep moving, so let's take our profit because we've made money. And so we take our profits again, just like what happened in the first instance. But in this case, the price came back, and you know, once the price is coming back down, those sellers who were here, those people who sold here, they are supposed to turn into buyers here. And so we are expecting that when the price is coming back, those who sold here will turn into buyers. Those who missed out on this price will also turn into buyers. But to our surprise, when the price come back down, we did not see them coming into the market. So the price broke through that price. The market broke through that price and kept on going down. So at this point, we think, okay, there is no need to buy again. Instead, let us sell. Right? So at this point, we sold. because we want to make money, because we are impatient, we want to make fast money. We saw the price, what happened, the price came down and we are happy, but all of a sudden during the running of this same candle, it went back up and closed above this place that we anticipated, this previous level we anticipated, and then market will start going up. This is how fake breakouts really happen. So what we really need at this point is the patience to see what is going to happen during the correction phase. We need the patience to see what is going to happen, and when we see the candlestick pattern confirming it, we are going to take advantage of it. I will be talking more of this later on in this video, so let's just get this straight. But before then, I would like you guys to like and share and comment and subscribe to the channel. It's a new channel. The subscribers are not much, and I really want you guys to support me so that I can keep making more of this kind of video. Thank you. Okay, so let's go on. Now in a downtrend is the same thing. A downtrend is the same thing, but now the motivation for price to make a fake breakout in a downtrend is entirely different from that of an uptrend. In an uptrend, like I told you earlier on, we have volume, we have aggression in buyers, news, emotions of greed. Yes, I know we have all of this, but in a downtrend like this, the reason price falls in a downtrend is because of one thing: there are not enough buyers coming into the market. That means we don't have enough aggression, we don't have enough volume, we don't have enough momentum. Maybe there is no strong news releases, and so what happened? The price falls. It gets to a level where we might feel, okay, at this level we might feel buyers are going to come in, but buyers will come in not too strong. Price, because buyers are not strong, price will fall. This is the law of demand and supply, if you all know it. When the demand is not strong in the market, what will happen? The supply will come down, so that it can get to a point whereby the demand will be strong. So it's always looking for a strong demand area. The price is always coming down to look for a strong demand area. So therefore the price has been falling. It has been falling from here. Now it got to this point, it retraced, it came back down again. So what we are expecting is, when price is coming back up, it will get to this point and it will come back down again. Let me make this clearer so that you understand. Okay, look at what I'm trying to do here. Okay, yes, this is what I'm trying to do here. I'll change it to red. Okay, so that's it. Okay, let me leave it like this before I mess up this presentation. Okay, so this is what happens. The price came back up here and it's moved down. Now we're expecting the price to come back up here and move down, but all of a sudden the price went up past where we expected it, and so we think this is a reversal. We enter into this market to continue with the uptrend, and all of a sudden we are seeing this red candle and we are stuck in a fake breakout. And the same thing happens in a ranging market. The same thing happens. The loss of momentum in the uptrend will cause a reversal, will cause a fake breakout. When the breakout is happening with loss of momentum in the ranging market, the fake breakout occurs, and so we get stuck in the markets and we get hit by the fake breakout. So from there now we'll start looking at how we can take advantage of this fake breakout. Now there are 4 steps we can use to take advantage of the fake breakout, and number 1 is to identify the dominant trend. When you identify the dominant trend, what you do next is to identify the first shift from the dominant trend. What I mean is the first breakout from the dominant trend when you identify the first breakout from the, when I mean, like we have a trend line, an upward trend line. The market is moving between the upward resistance and the downward support. So if the market breaks downward, we need to take note of that break downward. That's what I mean by identifying the first shift of the dominant trend. And then you need to wait to see failure of the assumed new trend. You need to see a failure of that assumed new trend. That means the break, you need to see it fail, and then you need to trade in the continuation in the direction of the previous dominant trend. I'll go further to explain this. So for instance, we have an uptrend. What do we have? The dominant trend, uptrend. Now I want you to know that there, at this point, we have up, down, up, down, up, down. We have it coming like up, down, up, down, up, down. I just made this picture that the screen can take. Now this is the dominant trend, uptrend. Price has been coming from here, going to support, going up, going to support, going up, support. But at this point, price came up, support, up. We are expecting the support to hold, but it broke. This becomes the shift. This becomes number 2. Identify the first shift of the dominant trend. Now after this, what we need to see, after you see the shift, we need to see a failure. Now we are expecting, after this breakout, we are expecting price to go down to form a new trend. But no, at this point where we got disappointed, we still saw buyers coming inside the market. Now when I said you should identify the shift, you should identify that point, that price, that zone whereby your expectation of price going up failed. Your expectation of price doing something which is going up failed. If you can identify it and you can see that price, instead of price to go up, price broke down, then you know you have a clue. So when you identify this, just wait, mark that price and wait for the market to come back there to that same price that failed to hold. When the price comes back down there, what's going to happen is simple. Market will continue to go down. It's as easy as that. The market will continue to go down. The market will continue to go up in the direction of the dominant trend. That is just it, and that is what failure is about. And this is the one for an uptrend. For a downtrend, after we see the shift, we're expecting here to hold and market to come down. We're expecting a trend, a correction, and then the trend again. But now we did not see the correction. The market broke up. When the market broke up, what happened? Instead of price to continue going up, we're seeing fail. It failed here, again it failed here, and this last candle confirmed it by coming back to this place. What we expected to happen before here is now happening here, and so what we do, we continue. So failure, when you see the failure shows you direction. But first of all, you need to have a dominant trend, you need to have a shift in markets, and you need to see the failure happening. And so the last one is for the ranging market. And so for the ranging market, is the same thing. We see the dominant trend, shift, and failure. Dominant trend, shift, and failure. Dominant trend here is ranging. It's not an uptrend, it's not a downtrend. The market is ranging. So we are expecting, if the dominant trend is ranging, the market should always be ranging. But all of a sudden we saw a shift in form of a breakout. Now even at this breakout, the breakout could not unfold. So the market came back to the dominant trend, and we continue what we've been doing, going with the ranging mode. So this is how you take advantage of the fake breakout, how you identify the fake breakout. So for the conclusion, I can say that a fake breakout is an unfortunate reality in the market, And recognizing their existence and understanding how to overcome them will allow us as traders to approach the market with greater caution and clarity. By understanding the psychology behind price movements, you can minimize the impact of fake breakout and increase your chances of success. So this is all for fake breakout. You can watch some of my live trading videos. There is the last trading video I posted. There is a trade I did specifically on fake breakout, and someone asked me to make a video on that. That's why I really did this video. You can see an example of what fake breakout is in that video, or maybe if I'm doing some other videos, I'll emphasize on the fake breakout part of it. So like I've asked you, please like this video, subscribe to the channel, and if you have any question, please leave your questions in the comment section, and you can share this video to your social media platforms and to your friends if you find it useful. So until next time, bye bye, peace, thanks.